Do you know that under IFRS number 9, not all loans are treated equally? IFRS number 9 gives us three stages model in order to account for the expected credit loss. And the transition from one stage to another will have a dramatic changes on the financial performance and financial positions for banks specifically. Here it how it works. At stage number 1, loans are performing. So at this stage, we don't have increase in the credit risk. So at this case, we are not required to calculate high amount or high value of the expected credit loss. We are only required to calculate the expected credit loss for only the next 12 months. And if the credit risk increased, we are going to move from stage number 1 to stage number 2. So at stage number 2, we will have a remarkable increase in the credit risk. And based on that, we are going to calculate the expected credit loss, not only for the next 12 months, but we are going to calculate it for the lifetime of the financial asset. So at this case, the expected credit loss will be much higher compared to stage number 1, right? And if the loan got impaired, so we have to move from stage number 2 to stage number 3, where we have a default at the customer positions. So we are really at the stage of Alf Mabruk, where we have impairment for our financial assets, where our financial assets got impaired and we have a default happen on the customer balances and the customer's positions, or borrower position, I mean. So at this case, we have also to continue calculating the expected credit loss for the lifetime of the financial asset. So what is the difference between stage number 2 and stage number 3? Because both stages will calculate the expected credit loss for the lifetime of the financial asset. The difference is here. At stage number 2, we shall calculate the return based on the gross carrying value of the financial asset. But in stage number 3, we are going to calculate the return not based on the gross carrying value of the financial assets, but based on the net value or net carrying value of the financial assets, meaning after deducting the impairment allowance. So at stage number 3, because the loans got impaired and we have defaults, so we will not be able to overestimate the return that we are going to consider or recognize in the financial performance statement, but we are going to calculate based on the net carrying value of the financial assets, meaning after deducting the impairment loss. So these three stages of the expected credit loss model forces banks to be proactive. We don't wait for default, but we anticipate it. That's the heart of IFRS number 9. Follow me for more practical tips on financial reporting, IFRS, financial modeling, and data analysis and Power BI. Thank you.